much like the previous report that Newmark had over the capital markets for CRE as a whole, it has some great breadth and depth in here. And there's actually some additional pieces of information that they have about the multifamily market that they did not include in their kind of general capital markets report a couple weeks ago. Because we've seen so many Q1 reports and we've seen so many multifamily reports come across, I'm always watching out for the things that are different. And the things that are new, or just these things that not a lot of people notice, or not a lot of people are, I don't want to say willing to say, but things that are perhaps de-emphasized.
Yeah, and maybe bucks the conventional narrative a little bit, because it can be a little bit of an echo chamber sometimes, and especially. And you've noted this before. I think that audience and sources are really important to kind of think about when you're reading these reports. Like, what kind of business does Newmark have, and what will there be their incentive? The same thing for Cushman and Wakefield, or Marcus and Millichap, or Berkadia. Like, where are they coming from? And that has a direct correlation, I think, to the kind of information that they're going to present, either the information that they have or the information that they're inclined to present. I think all of them are beholden to accuracy. They want to present. They want to have a reputation.
They're not going to lie. But it does mean that certain pieces of information are communicated more clearly than others. So with that in mind, a paragraph in Newmark's report really stood out to me, and it said, while appreciation has been the primary driver of total returns recently, investors may shift their attention to markets with higher income returns should growth slow. A reversion to the mean is also possible, with appreciation returns accounting for 19.8% over the trailing 12 months, well above the 10-year annualized average of 4.6%. This is kind of a tough fact, but I don't think it's entirely unexpected.
I think it makes sense.
Yeah. Even in January, the projections for the multifamily market had growth at a lower level than 2021. So it's not like things have really materially changed when you're thinking of that statement. I also think them singling out appreciation as a particularly vulnerable to kind of a reversion of the mean is interesting. I might be reading too much into their statement here, but appreciation returns going down could be due to the fact that renovations are more expensive. And so you can't kind of force appreciation. And it also could be due to a market that's had increasing competition for an extended period of time. And now we've got a market that's highly competitive, but there's not that steady stream of new competition maybe entering the market that's out there to bid prices up higher and higher.
You know, I think a lot of it comes down to kind of what your basis was. And, you know, some of the markets that had just incredibly low cap rates, you know, the cap rates that were, sub 4, kind of in the mid 3s. And it's a lot of the markets with high growth rates, whether it's Phoenix or some of the markets in Florida or Texas. But it's a factor of the cheap debt that we saw last year that just doesn't exist today. And so you're going to have a lot of cases, people are already borrowing with negative leverage, meaning your cap rate's higher than the interest rate that you're paying. And your yield on cost is higher than the interest rate. And
that's the impression that I've been getting over these past few weeks as the market kind of reacts, and as so many reports kind of consider the effects of these interest rate hikes, is there are certain property types, there are certain markets that are sensitive to these changes. And it could be that the ones that have been such high flyers, they get a little bit more sensitive to these changes, whether it's on the up or on the downside.
Well, what I think is going to happen is we're already seeing cap rates tick up because just people they can't buy at a 2 cap or a 3 cap when they're paying mid 3s to 5+% on the debt. But we're still seeing an incredible amount of top line growth driven by the organic rent growth, the difference between in-place rents and market rents. And so we're going to see continued net operating income growth over the next couple of years. It's just is that growth going to relate to the expansion of cap rates? And so I think it's really that rate of growth, which is, and this is true kind of across the economy, other asset classes, but it's that rate of growth for asset prices is going to kind of slow down to more normal levels. I mean, it was crazy the last 2 years. And so, but I don't think we're going to see price declines. I think we're going to see just that growth decline, maybe even be flat for a little bit. And I think that's going to lead to some, that we touched this earlier, but it's going to lead to, more uncertainty, decreased sales volumes. But I think it leads to some opportunities because you can buy at slightly higher cap rates. There's still some attractive financing out there. But it's also going to be a shift to, and I think this is what you were hitting at and the report's hitting at, to markets that are going to be a little bit more insulated, more focused on cash flow. And I guess this is the same disclaimer that we gave to the influence of who's writing these reports. So we're biased in this case, but it's really empirically the return profile of some other markets that are growing but are more focused on cash flow, free cash flow and income versus appreciation, like markets in the Midwest, some secondary and tertiary markets in the Southeast, not the big major markets. Maybe like your Atlantas and, in the Southwest and Phoenix. But there are some markets that have good growth that just the cap rates never got so crazy low that you can still find cash flow. And we've seen this happen over the last couple of months, even really kind of before some of these interest rates started rising, because I was speaking to a lot of investors who were saying, we're invested in the Sun Belt. We're invested in Florida. We're invested in Texas. We're looking for a slightly different return profile, something that produces more cash flow, that's a little bit more stable. They're looking for some ballast to their portfolio. And now that these, again, low cap rate markets are looking pretty high risk, because there's also a lot of supply coming into those markets. And so they are flowing into the Midwest, markets like Indianapolis, like Cincinnati, like Kansas City, like, Columbus, Ohio, Lansing, Michigan, Grand Rapids, Michigan, markets like that. For their return profile and their stability, looking back at past recessions, past performance, and the fact that they're not being threatened by oversupply, but they've been mispriced, because a lot of these markets have good growth, but they're just not getting the capital inflows, or they didn't receive the capital inflows that the crowd was pushing into the Sun Belt.
Yeah.